Hello and welcome to Dialogue. I'm Yang Rui in Beijing. The first half of 2016 saw a surge in China's outbound merger and acquisition deals, hitting a record $120 billion in total value so far, according to Thomson Reuters data. Why are Chinese companies' overseas mergers and acquisitions surging this year? What opportunities and challenges Chinese companies, and are they prepared? To discuss these issues and more, today I'm pleased to be joined by Mr. Harry Nussel, the Chief Executive Officer of Datur, and Mr. Charles Liu, founder of How Capital. But before we get started, let's have a quick look at this.
An article in Forbes magazine titled 5 Reasons China Outbound M&A is a Long-Term Trend has sparked heated discussion online. It says that during the first half of 2016, China's outbound mergers and acquisitions volume reached more than $135 billion, larger than the full-year total for any year previously. Through June, Chinese companies accounted for 23% of all cross-border deals globally. It also says that in addition to the total volume, the number and size of deals out of China are on the rise as well. These impressive figures have further fueled the discussion over Chinese companies' aggressive global performance. In April, when responding to queries about China's outbound M&A, a spokesperson for the Ministry of Commerce said the volume and growth rate were in a normal and reasonable range. Along with outbound Chinese investment, inbound and domestic M&A in China also developed rapidly. In the first quarter of this year, M&A by foreign capital in China saw a 24.5% growth year-on-year.
China's outbound M&A is still in its primary stage. The deal volume in 2015 indeed saw a rapid growth, but it only accounted for 6.2% of all cross-border deals globally.
According to the Internet Data Center of the National Development and Reform Commission, the top 5 most popular target nations are Japan, the US, Germany, the UK, and Brazil. Home appliances, environmental protection, the auto industry, banking, and insurance are the most active areas. And more capital is moving to the high-end manufacturing and service sectors. Many observers hope an outgoing strategy can facilitate the transformation and upgrading of the Chinese economy. However, challenges and risks for China's outbound M&A are increasing as well. Scrutiny directed towards Chinese companies is getting stricter, but, as the Forbes article suggests, many believe China's outbound M&A won't be just a short-term phenomenon.
Welcome to Dialogue, gentlemen. In the first half of 2016, the total volume of M&A has surpassed the full-year total for any previous years. Now, what's the driving force?
I believe it's the gradual slowing of the Chinese economy and the slower growth rates of both the SOEs and privately owned businesses, so that causes them to look beyond traditional organic growth and try to expand more rapid growth through mergers and acquisitions and integration. Also a desire to get technology that may not be available in this country. Just trying to address a larger global marketplace.
I think ultimately for any businessman, the key is to seek yield or look for returns. And if the return in China is less than elsewhere, and the prospect of maybe not substantial but somewhat significant RMB depreciation exists, it's always good to acquire assets which will bring in a higher level of profit in RMB terms. And there's another aspect which I think is very significant, is the willingness and the sophistication and maturity of private sector in China to seek out what is strategically meaningful for them for their global expansion. It's no longer the SOEs who are dominating the outbound acquisition. In the last decade, it was principally the SOEs, but today it's the private sector.
Look, Harry, Charles' understatement suggests clearly that the investors from non-public sector in China displayed a lack of confidence about the prospects of the Chinese economy. Therefore, we have an increasing amount of outbound capital flight. How serious is this? First of all, do you think this is true?
So I don't know whether his comment was fear about the growth of the Chinese economy. I think his comment was focused on the relative growth of the Chinese economy versus other opportunities, and where can the investor, the capitalist, get the highest risk-adjusted yield on their investment. So it may not be a fear of the Chinese economy as much as seeing greater opportunities and greater growth rates elsewhere.
It's not just a question of greater growth, but strategic alliances or strategic synergies. If you are already dominating the Chinese market in a very serious way, you want global expansion. And acquisitions may mean channels for your products. It could mean many, many things. It's just a more global macro view by a lot of the Chinese entrepreneurs who are viewing the whole world as a market rather than previously just China.
Look, here is an allegation that the Chinese authorities deliberately encourage the outbound capital flight. Why do we have such preferential policies? And on the other hand, I'm afraid the central government, for example, has started to tighten the grip on the capital outflow, because you know what I mean. We want to stabilize the economic growth.
I mean, there is a perception that the Chinese government is encouraging strategic acquisition activity, particularly to get control of technology or products that they think in the long run will be useful for China. I don't know if that's true or not. I think the tide of globalization is tugging businesses around the world to have larger marketplaces, as Charles described, get access to better technology that'll have greater returns. It could be those forces pulling it along. The world is getting more comfortable. There used to be xenophobic fear of any outside country coming in and buying a key technology. But at the same time, you see growing populism around the world, whether it's in France with Le Pen, Brexit, Donald Trump in the US. So these are conflicting vectors pulling in different directions. But I think Charles' point was really the driving point. For technology in a lot of industries where there's very little cost of transmission, money is going to flow where it gets the highest risk-adjusted return.
And I would also add, based on your comment, there's a difference between outbound investment and capital flight. I think the expression capital flight is really not well placed here. You have maybe people wanting to buy houses in New York or Los Angeles. You may consider that capital flight. But in that case, in many cases, it's for their kids to go to school there.
But in Canada, for example, the crazy property purchase caused strong protests from local Canadians.
Sure, except is that capital flight? Because in terms of hundreds of billions going out, a few $1 billion here and there to buy some housing is not very significant. What is really capital outflow or outbound investment in a macro view? Outbound investment is part of the globalization of the world's economy. It's very, very significant. You go, for example, SOEs buying natural resources before, they had to. Or in the case of others, buying assets that has synergies with your assets. Like, for example, Wanda buying theater chains. They bought the ones in the US and now they just bought it, given the pound has fallen so much, bought a chain in Europe. So these are things which are tied to the theater chains that Wanda has in China. So you could argue that it is strategic. It is not capital flight.
Any comments, Harry, about the long-awaited opening of China's capital account? I wonder if that has anything to do with...
I think there is a perception that some of this investment is being driven by a desire to have an investment other than U.S. Treasuries. So, which very low yielding assets. It's helped propped up the U.S. economy in a number of ways, but is it the optimal place for the Chinese government and the Chinese population to have that capital sitting? So I do think that's one of the factors. You're seeing people saying it doesn't have to be treasuries. I do agree that this isn't a flight capital issue. You know, when you see people buying expensive houses, that's just the polarization of great wealth around the world, and whether that's from Russia, sub-Saharan Africa, China, Latin America, it's a very small part of the dollars we're talking about. You know, a more iconic, you know, when Lenovo bought IBM's PC business, right? I mean, hard to imagine a more iconic U.S. business than IBM selling its PC business to Lenovo. That was a significant event in the technology world, saying, here's a Chinese company that can do a better job running the PC business.
Let me ask one follow-up question on what you said earlier in response to the driving force. What's behind what's the driving force? Now, you said the Chinese companies want to acquire good technology.
Right.
Does it mean it'll cause more protectionism? Look at what's happening in the United States now. The U.S. federal government bans any high technological transfer because that'll be used for dual purposes, right?
Maybe it's beauty is always in the eye of the beholder, and you look at the trouble people used to have with CFIUS reviews, but the percentage of CFIUS applications coming from Chinese companies has steadily increased. They're getting more approvals. There is always going to be a concern of, is some key country asset going to be acquired and taken away? But the tide of capitalism usually overcomes that. And you can look back in history, and you know, I don't think any country has been able to successfully hold on to its assets and key investments for long. It will be pulled around the globe.
Henry, I will get back to you about more questions on M&A in the United States. But Charles, let's look at Huawei, which is fast becoming a global player. And there are a lot of acquisition mergers in developing countries. Is that because of the protectionism by developed nations? And
I don't think you can say developed nations, because in terms of going against Huawei, it's really the United States. Because in terms of Europe, Huawei's laid out, I think, more than half of telecommunications infrastructure. Mm-hmm. The fixed line, in fact, in the city of London was laid out by Huawei. So it's really the United States which decides, okay, we don't want Huawei in the US because it could be military tied. But Europe is totally open to Huawei, and Huawei has done very, very well.
Excuse me, why do you think there are such big differences across the Atlantic Ocean with regard to Huawei's behavior?
I think it's what said. I mean, I think Li Ka-shing and Hutch has been welcomed around the globe with their telecommunication businesses, which have been very successful. But with Huawei, there's always this ghost in the room of military history, what's really going on.
But Huawei has employed an American lawyer, I'm afraid, to defend its investment in the United States.
More than that, they've hired a lot of American managers as well.
Maybe that's their problem.
I think in terms of Huawei's case, they pursued the U.S. market, but I'm not sure they pursued it in earnest or really that aggressively, because you don't really want to cause too much attention to it, first and foremost. But even more importantly, Huawei it's been suspected that they have a strategy of not killing all potential competitors. Because if they become a complete monopoly, which they're capable of becoming, and really killing Ericsson and Alstom and the others as well, then there are anti-monopoly issues that they have to address. So they keep some competitors going and continue to advance where they can. For example, the latest for Huawei now is cell phones. It's not infrastructure anymore. their cell phone sales are going up 20, 30, 40% a year and have become already a dominant force in Europe, competing head-on with Apple and Samsung. So,
thank you very much, Harry and Charles. You are watching Dialogue with these two gentlemen. We're discussing the overseas mergers and acquisitions of the Chinese companies and whether this is a barometer of a Chinese economy which is going global. We'll be back in a short while. Stay with us. Welcome back, gentlemen. China has taken specific steps to make it easier for its companies to acquire overseas. For example, regulatory revisions enacted in the beginning of 2015 eased restrictions on SOEs, which in the past have been required to obtain approvals from a variety of regulators to invest overseas. What's your opinion on China's going out policy?
I think every successful business that I'm aware of has a mindset of going out and going global. And I think if you aren't willing to go out and reach out like that, you're going to atrophy as a business.
We've been discussing political uncertainty in some of the developing countries, some of which might be what you call democracies, like Sri Lanka and Venezuela. Hambantota Port is a case study that the media pays particular attention to. The two major political forces in Sri Lanka competed for power, and we fell victim to the democratic oversight, the political opposition. Fortunately, the new party that took over the government agreed to further cooperate with the Chinese investment. Having said this, let's look at Venezuela, where Maduro, successor to Hugo Chavez, vowed to continue with his left-leaning policy that has seriously angered the opposition, which got a strong support from the United States, which suffered heavily due to the state annexation and the takeover of the Western capital and investment. So what do you think of the lessons China should learn from these cases? What's your counsel for prospective Chinese investors legally?
Well, geopolitical risk exists everywhere. So you look at what happened in Venezuela.
Don't you think the greater risks we have, the more return we're going to have?
Well, that's what you hope, but I guess one of my rules I always counsel people on investing is don't make bets you can't afford to lose. So don't make an investment that if you see a geopolitical change, you can't deal with.
But I'm afraid, Charles, you have a better knowledge as to the behavior of the SOEs, who in some cases don't care about the losses.
I think if you talk about gains in terms of profitability and so on, you also have to think about the not so tangible returns. For example, if China has a serious overcapacity in certain sectors, if it could arrange for more exports done at concessionary rates, even if it's not very profitable, for the major SOEs to be able to not lay off so many people, it's intangible benefits that one could have. Secondarily, as China is a rising nation, it is being hemmed in, I think geopolitically, by those who don't want it to rise, sometimes to provide subsidized or low-cost financing for investments, for projects abroad, may bring tangible political or geopolitical benefits. These are issues which I think the central government has to consider and are considering.
What do you think of the reputation and image of the SOEs for some of the cases? For example, in Australia, we addressed the case of Huawei, but Huawei is a top representative of the non-public sector, a successful one.
Right.
But what about the SOEs in Australia, which does not fully trust, the state-owned enterprises? We are talking about the iron ore and acquisition of some of the iron mining.
I think that there's generally a wariness and skepticism of doing business with governmental entities.
Why?
Anywhere around the world.
Anywhere around the world.
Not just China. Their motivations and their alignment may be different than the profit sector.
Much more complicated.
Right.
Much more complicated. But I think in terms of the iron ore mine situation, there's one specific case. One of the largest companies in China, conglomerate, made an investment, lost billions of dollars. But it's not just them who lost billions of dollars in iron ore mine. After the financial crisis, when China did the huge program of infrastructure building, iron ore prices went crazy. It doubled or tripled. And many large non-Chinese conglomerates went into it too and have also lost a lot of money. In Guinea, for example, right now, iron ore prices are 1/4 of what it used to be just 3 years ago. And these are not Chinese owned. These are British owned. So I think, you know, in terms of these type of investments, it's not just particular to the Chinese companies or China. It is a global,
SOEs, right?
or SOEs. It's a global capital pool. An opportunity.
Anglo is in the FT today trying to offload assets. Glencore's. It's everywhere.
Oh yes, right, Glencore.
Given the curse of resources of some of the low-income economies, don't you think this is a good time for the Chinese investment to acquire iron ore, mining, oil, whatever resources whose commodity prices have dropped significantly in recent years, and it is a golden time for us to seize the opportunity?
Who's to say? Who was going to guess? Look at all the people around the world who misgauged the effect that fracking and natural gas prices would have on oil prices around the globe. Some people could say fracking broke the OPEC cartel. So yeah, it seems to be a good time to buy. Interest rates are low, prices are down. We'll be back in 5 years and let you know.
Exactly, because if, for example, in terms of oil prices, it went down as low as 20-something, went back up to over 50, now it's down to the low 40s again. You never know what will happen. Not only that, in terms of iron ore, I don't think there will be another 4 trillion RMB stimulus program anywhere. And the other developing countries which are desperately in need of infrastructure building don't have the money.
Like the Philippines.
Exactly.
Yeah, President Duterte vowed not to touch the issue of the arbitral tribunal in order to attract more of the Chinese investment.
Exactly.
For the building of its infrastructure.
And then if India is to build the infrastructure, we're talking 4 trillion RMB is nothing. Right. We're talking about 20 to 30 trillion. They don't have the money. If there's no money to build it, then there's no demand for iron ore. You might be sitting on your iron ore mine for quite some time.
Harry, what's your advice for Chinese investment to go to the Philippines because of the very, favorable political conditions that might be the groundwork for the infrastructure construction?
I think the outside world generally views Chinese investment philosophy as wise, disciplined, rigorous.
I'm not so sure.
You're closer to it.
I can cite some very specific examples of very large groups in China. I won't name them specifically, speaking to very large owners of assets in Europe or and the owners of the assets in in Europe, especially in London, will come and say to me, Charles, we're not buying cabbage and tofu on the street. It is not so simple. And they hope the Chinese acquirer become more sophisticated. There are all kinds of regulatory issues, especially when you get into the financial sector, financial services sector. There are all kinds of local union issues, the employment, and so it's actually quite sophisticated. I don't think for most of the foreign asset sellers that I've been working with or in touch with, I think there is a sense of frustration. They don't understand the Chinese thinking, and the Chinese don't really understand their thinking. It'll be some time.
Two more questions, Harry and Charles. One is very quickly, what do you think of the impact of a Brexit on the chance and opportunities for the Chinese investment to have an M&A in Britain?
What is there to buy in Britain?
Exactly. I was
Other than nuclear
I was
power plant.
leading the panel in our London office last week, and they said, "Don't you think this is a great time to come and buy businesses in Britain because the pound's devalued?" And I said, "Well, so's the EBITDA stream. So tell me why it's a better time than it was before." We don't know what Brexit's going to mean. I look at it, I don't even know how Britain's going to get out of the EU. It's great to say the vote's done and out is out, but you look at the difficulty they're going to have before they exercise under Article 50, how they're going to negotiate all these treaties. So I think it will lead to a slower economy in Great Britain, lower values. That may turn around. There is, one of the common themes about Chinese investors is they have a longer-term horizon and a lower hurdle rate than other parts of the globe. I always hate stereotypes and generalization, but if you believe that's accurate, maybe it is a good time to go buy.
And Charles, the last question is very much about whether the current dynamics and the momentum of our trend of M&A in overseas market will be sustainable.
I think it's going to be more than sustainable. I think it might in fact accelerate. Whether or not it's US based is a different story. I think it'll be much more European. Now, speaking of Brexit, we talk about the entire EU. What happens if EU, for example, many people are now talking about the EU actually falling apart within the next 10 years. It's not just Brexit. Italy is on the verge, and Portugal, of course, and the others. What happened, what the Chinese government has done, and I think many Chinese companies have done, is to start dealing with them bilaterally rather than through the bureaucrats in Brussels. Now, if you start dealing bilaterally, this is where money really talks, and you can have a lot of leverage. I think the assets of northern Scandinavian countries, technology of Germany, and northern Italy, the Netherlands, maybe even France. There's some very, very interesting collaborative opportunities between Chinese enterprises and these companies. And their markets are shrinking. There's no question. They also need the support from here.
I would just echo a little more strongly what Charles said. I think outbound M&A activity will not just be US focused. It'll be global focused, and it is irreversible, inevitable.
Thank you very much. With that, we've come to the end of this edition of Dialogue with Harry and Charles. I'll see you next time. Until then, goodbye.